want to own the entire S&P 500. So I think
Hey, afternoon from London. It's 1 p.m. and it's 8 a.m. in New York. And good morning to everybody and welcome to probably my favorite trading event of the whole month. What most traders are scared off and avoid and haven't got a clue what they're doing with it. We make some of our best wins on NFP day. So welcome to join the show and learn how we do true scalping. All the information on how to join our group, join our VIP Discord group, and you get me as your mentor, so you can learn how to use this trading system that we designed for the group and how to trade fundamentals. Just go to www.mohawkforex.com or read the description in the YouTube channel below. So thanks for joining today and watching this back, and obviously as always we're going to be looking at the US 30 and gold. Primarily we're going to be trading gold on the NFP actual result itself. We'll try and get in on the initial release, but sometimes, well, most of the times we end up trading it after we've had that initial push. We catch the rejection and then the trend that's set by the actual news event, and then we retrade it all again once New York opens at 9:30 a.m. So we've already had some good results trading the market PMIs, which were all bad news in Europe earlier on, and we got some sells on DAX, which is really good, and even US 30 followed suit with all that. And the thing today we've got to watch out for is obviously the COVID news. With the Omicron, kind of NFP has been almost left out of the news, been taken a back seat compared to what it usually would, because the markets have responded to Omicron because there's still uncertainty about how dangerous it is, how effective the vaccines are against it. So one of the markets are ditching and the markets are pulling back and ditching and ranging. So it's pre-market news. I'm hoping for a big enough result on NFP to get a move in the correct direction, reverse on gold and the general direction on US 30. As we know, pre-market news, usually we go the reverse, but not with NFP because it tends to be the biggest mover. And as you can see, US 30 is already kind of shaping up. It's costing in, pricing in. It's predicted to be 550k from 531 last month, and that's an increase. So that's good news. In the private sector, it's a decrease. An unemployment rate is just meant to be shaded down 0.1%. So if these two go in the same direction, the private one really won't be as relevant. And then we've got the market PMIs 15 minutes after the open, New York Open, which we can trade. And then we've got an ISM manufacturing PMI for November as well. So we've got some interesting news to trade on the back of just NFP as well. So it's going to be interesting because, like I say, the markets, I'm watching Bloomberg, listen to what Bloomberg is saying as well. I can see it, always have this on my chart. They're just saying how much of an impact this result's going to be compared to the downside caused by the Omicron. But as you can see at the moment, US 30 on my 3-minute time frame is steadily pushing up when they hit our heavy resistance zone. So we could have been trading this right now. We could have been in here for one buy here, another buy here, another buy here. So I'm just sat here waiting now for the NFP to come out in 20 minutes or so. That's what we're looking for.
I think that the Fed is certainly not in a position where they want to roil markets and scare investors. But I just wonder, do they have the tools to essentially accommodate an environment where inflation is
having a coffee,
rise, economic activity is building, and that's positive for the economy. But we're starting to see labor inflation really creep into margins. I mean, this is an environment where I don't know if the Fed's...
We'll try and open 2 or 3 positions on the initial release. We'll try and open 2 or 3 positions on the pullback, and that's kind of how we will try and play it.
A pretty big pickup in rates volatility. So we're more likely to see rates volatility. We're more likely to see equity market volatility. This is a different environment than what we've enjoyed over the last couple of years or even the last decade. And in that environment, the number one factor that we need to care about is the cost of equity capital. If volatility rises, the equity risk premium increases, and that's basically game over for a lot of these.
Look at gold, it's switched to gold now. Gold's our main focus. Like I say, yep, we're certainly up, gold pulling back nicely. RSI 35 below. Again, we could have had sells on gold here. We'll set our zones. If the news is better than expected, at the moment we're looking at 1768 on trading view. Obviously you've got to readjust it for your own broker. And at the moment our breakout zone, if the news is worse than expected, is going to be 177. These are kind of the rough zones. Again, I don't set pending orders. This is just to give me an idea of where price might go to before it pulls back, or if it continues, if we get a breakout candle over these zones and they get a continuation, as long as RSI will either be in the overbought or oversold zone by then, so we can add more positions to our trade. You can see here it's all on trading view. 550 predicted over 531, and employment rate, everything's already nice and smooth, nicely loaded in for you. And then obviously we've got these nice extra bonus trades at the end of the day as well. So we're going to stay live for a couple of hours and see how many pips we can bag. So it's early for you guys in New York. Well, if you want to bag the pips and you want to be scalping, you've got to, fortunately, you've got to get in on the times and gear up.
For being with us, looking back on this year and looking ahead, Tom, to next year. Some really firm calls coming from Bank of America, looking ahead to 22.
Oh, they're nuanced. Let's not forget Francisco Blanche walking up to $100 a barrel. That gets your attention.
It gets my attention too. 8:30 Eastern, your payrolls report. That payrolls report, 20 minutes away from New York City. This is Bloomberg.
With that news, I'm Risk Gupta. Traders are waiting to see if the November jobs report is as strong as surveys forecast. According to the median estimate of a Bloomberg poll of economists, employers added 550,000 jobs last month, and the unemployment rate fell to 4.5%. The figures could shape expectations for the pace of Fed policy tightening. We'll have the jobs report at 8:30 a.m. New York time. Congress has averted a U.S. government shutdown on Thursday night. The Senate passed a stopgap spending bill and sent it to President Biden for his signature. The bill will pay for government operations through February the 18th. Without the measure, the government would have been forced into a partial shutdown after midnight Friday. And in New York, dozens of hospitals are nearing capacity as the state reported the most new coronavirus cases.
So we'll always keep an eye on the news here. It's the best thing to do.
Cases were recorded, at least 5 cases of the Omicron variant.
And we've got investing.com poised as well.
Had bed capacity of 10% or less. Today, state officials will be allowed to limit
report, yeah, what's moving the markets. We've read all this already. And then we've got 15-16 minutes to go. Like I say, you know, you don't want to be in any trades ideally, because you are gambling. Then if you're stuck in a trade waiting, anticipating that it's going to be good news and this is going to rock it up, then you know, just you're fooling yourself. You don't know, no one knows. But will be our EP zone at the moment. These will all get adjusted as we get closer to the time. If the news is way better than expected, we'll want to see a push on up on US 30, and if it's going to be bad news, then obviously we're going to break this zone here initially. So we'll set it there. And if these zones get broken, then we continue. But at the moment we've got re-entry points for buys on US 30, and gold is just ranging as we'd expect it. Zoom in now, that's what we want to see. Like I said, we're looking to try and get magical 100, look, 250 points each one. Latest update on the figures, everything lining up. Europe will follow suit, remember, a lot of the time. So Dow Jones overbought already, SP overbought, Nasdaq getting that way. I kind of read it.
Financial world on demand.
Everything pushing up, as you can see, based on that. This heavy resistance is really cool that's coming. That was a beautiful W. Look at that. People don't believe in patterns. Tap, up she goes. So where the nice big M here looks stretched out. Tap, tap, W. Now obviously we're looking for the M pattern to form, would be nice. i.e. the news is worse than expected, we get a drop, we get a pullback, we get a drop back to our trend line. Would be perfect. I say we don't predict anything because we just don't know which way things are going to go.
Are you worried about people exiting pandemic era and going back to the gym, or are we going to work out?
We'll just stick on watch gold for a minute so I'll grab a coffee. Drink. 10 minutes to go.
Influence the 150 million people in North America specifically who are overweight or obese and haven't made that choice yet.
Like I said, with NFP you'll get gold, you'll get USD moving way before you get the result. You don't panic, you don't get in, you know, you just wait for the result to come out and then look at price action and decide whether you're going with it, if you've caught it right, or you're waiting for the pullback.
Right at home so that they get results. That's our job, is to help the new person engage in healthy lifestyles.
On the supply chain, are you starting to see things improve? And if you are, where specifically, sir?
Well, this year we have been mostly affected by the semiconductor situation, and we believe that the quarter three was the quarter that was most effective.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is a much more rapid recovery, and we're very far along towards full employment, with the Fed still doing QE and pinning short-term interest rates at zero. That is a policy that
30. Go hitting that heavy resistance. Like I said, look, just pulled out the zone.
Backdrop in place.
Keep focused on gold. Look, we've had some nice spikes either way.
Set to adjust December 15th. That Federal Reserve
We want points look either way.
Payrolls this morning, they're 12 minutes away. Inflation data at some point next week, to the back end of next week. Going into payrolls, 12 minutes away. Futures
12 minutes away.
Highs just off them, positive 0.2% on the S&P. Yields come in a couple of basis points on a 10-year to 142.23. And just hearing from South Africa's National
And one lots this time on standard.
Just getting some early data.
Crazy.
So I'm going to read it out verbatim, and you can draw your own conclusions. In the early third wave, 66.1% of admissions were severe. In the early fourth wave, that number, Tom, is 32.9% of admissions are severe. There is a huge focus on the Omicron variant, Tom, and we're all waiting for a fuller picture of things. So this is an early take by South Africa's National Institute of Disease. 66.1% of admissions were severe in the early third wave. In the early point of this wave, Tom, the number is 32.9%.
And quickly, John, to get to our two good guests here, you know, I don't see South African Rand really moving on this, but I would suggest, somewhat off this news, we saw a continuing flattening here with the 2-year yield in America, a higher yield, which is sort of a sigh of relief move.
Yeah,
I don't know, Tom.
I don't want Mark to market this story every time this data comes out. I want to go back to the process, and the process for all of us is as follows. How contagious is the disease? How severe is it? And how well do vaccines stand up to it? In the early part of this story, we haven't had much data at all. To get a full picture of this, we might have to wait another couple of weeks. But early indications, Tom, indicate everywhere we look at the moment that the cases have been quite mild. And what we're hearing from South Africa this morning backs that up. Though, as I say, Tom, and I keep repeating this, you do too, I'll stress it again, it's early days. We need more data.
Right now, we're going to do the jobs report. Michael McKee to join us here in a moment to get us set up for this really interesting December report. James Glassman joins us. He's head economist, JP Morgan Chase Commercial Banking. And what's so important and well-timed, Jim, and having you on is Savita Subramanian of Bank of America was just on with a cautious view for 2021. And John was gracious and said, you know, where were you a bit off the mark? And she quoted Glassman 101, which is corporations adjusted. You're the king of this. How are corporations adjusting into 2022?
They've done an amazing job because they had to survive, right? And so they've learned how to do it the Amazon way, which is you got to learn how to get on the digital channels and reach customers. And the guys who did that really did quite well. And it's really amazing when on the surface, when you look at the U.S. economy, national output is back to where we would have been had there been no pandemic, but we're doing it with a lot fewer people. Which is why I think the Fed is hopeful that we're going to pull all these people back in, and we can manage above trend growth for another year, and not run into the inflation problems. That's going to be the interesting thing.
With all your commercial relations, Jim, and the decades of work you've had across America, are corporations managing for the next quarter, or do you actually see anyone developing a 3-year business plan?
There's a lot of that discussion going on. People are asking if we're going to be dealing with supply chain problems.
8 minutes to go. Price action, bearish move on gold. So see, this is it. Gold's anticipating the news to be better than expected. US 30s, at the moment, news is pushing up. Yeah, I know it's come down, pulled back a little bit. So this is where I'm thinking, is it going to be the opposite? Are we going to look for buys on gold?
Most people are saying, let's sit and
Excited.
Really
See, we've got 7 minutes to go.
People are looking at, they're trying to figure out where is this going over the next several years. Everybody knows all kinds of people right now, and they're dealing with price pressures and all that. But I think that is the number one question for folks, because they're thinking they got to be thinking more about automation, and rethinking where they should be locating a lot of this stuff. I think most people realize that these bottlenecks we've got at the LA ports and the trucking channels, they're not going to go on forever. We're going to get through them. And then you're going to ask, what's the more lasting impact? Higher cost of labor or more of the kind of congestion we're getting?
So we've got about 8 minutes until the payrolls report. What's the most interesting aspect of it to you? Is it the headline number? Is it the wage increases that we see? Or is it labor participation?
I think now the issue is becoming more labor participation, because we've done a pretty good job getting back to where we once belonged. We got unemployment almost down. Officially, on the surface, it looks like unemployment is kind of back to where we were before. And now the issue is, what about those 4 million people who kind of dropped out last year, which is the reason why you're seeing so many help wanted signs? Are they going to be coming back in? And if they are, I mean, the Fed wants to normalize its policies, but they're going to be a little more cautious if they see signs that more and more people are coming back in, because we're not really quite there.
Jim, we've got to leave it there.
Participation is.
We've got to run. It's got to catch up, sir, ahead of payrolls, as we always do. Jim Glassman of JP Morgan, Chase Commercial Banking. We have to leave it there because Tom Keene, drum roll, Mike McKee made the ring walk. We need to record that ring walk as Mike McKee enters the studio. Mike McKee looking ahead to payrolls data.
6 minutes to go.
Give us the guide, Mike. What are you looking for?
Well, we are looking for something in the range of the consensus 550,000, the whisper number on Wall Street, only a tick higher than that, although the entire street kind of leans that direction, I think, at this point. This is going to be a checklist.
They're looking at 550. We want 600. If it's 520, 530, it's buy time on gold.
For jobs, unemployment, and for labor force participation, the Fed can just say,
Depends how quick this result comes out on my FX book, of course. Always at the mercy of the news, and you can watch price action the same time as well and see.
Amazon hiring 4 million people and all that. Are there going to be some goofiness in this report, like Amazon, Target, the others?
We're not expecting anything, but everything over the past year has been goofy. These numbers are seasonally adjusted, so they take into account the holiday hiring. Although the interesting thing is, with the difficulty
What we'll do is we'll watch the live price action.
we've had more
What comes out. So 4 minutes to go. Good luck, everybody. Let's see what we can make on all this today.
Can they find those people? The one thing, if you are one of those people who looks at the 47 pages, look at warehouse and couriers. That's where the numbers. Yeah, that's where the numbers show up, because that's where all the temporary delivery people
on,
go.
folks. Lisa, who would have thought warehouse and courier?
Well, and how much more they're getting paid. And this really goes to the hourly employment. Just real quick here, what's the whisper out there? We're seeing 5% as the estimate globally in terms of the year-over-year wage increase. What do you think it is potentially going to be?
That's probably as good an estimate as any. That would imply a 0.4% increase on the month, which is about what we have been seeing. The Fed would like to see that continue to rise, but maybe not at that rate. And if we are getting more people into the labor force, that'll take some of the pressure off it. It's all things they've got to consider. They've got to put all this together and make sense out of it.
Mike McKee, sit tight. We're 4 minutes and about 15 seconds away from the payrolls report in America. Full reaction.
We're going to adjust gold. Look now, the level. Obviously, this is going to break, at least spike and touch if the news is better than expected. So gold will drop. So now we're looking down to this level here. Look, a zone. Down even more to look 40, 50, 100. So
to put us ahead of the curve. Copper, the unfair advantage.
Where's the same still holding? In that holding position now. Get a break below here, break above. Gold look already clipping, so now we can, yeah, we're looking for our next level. Here's our master support level here, 1766. Let's see if this really is going to be an expected result. So we'll get the down and then we'll get the push up on gold. Go with the news result and then go against it. Right, we'll load up. 2 minutes to go. Just going to file up my broker, make sure we're all go. Going on ones on this time. Been trading 0.5s all week because of the corona news, obviously. So it's just half my lot size.
So what happens is that we create some icons, we call them tags, and they have a signal within them. And when you stare
Sold gold on the open, bought DAX on the open. Bang, there were wins. Caught this here. NFP, look at this re-entry point now, look perfect. But just for a few dollars. 69 points. Stable. No close now. Is it going to rock up? Is it going to be worse than expected? We've got 1 minute to get 50 seconds. And I'm over screen now. We're counting down. Good luck, everybody. 1 minute to go.
There's multiple places where we think this technology will be applied. Perhaps, I don't know, driving or commanding unmanned vehicles or unmanned naval vessels. Perhaps providing menu selection and control within a control room environment, maybe in a nuclear power station. All those kind of things are perhaps in the bailiwick of this technology.
People are talking about Bloomberg surveillance.
17, 20 seconds. Here we go. Good luck, everybody. Let's watch the price action.
What did it say about me? What did that particular gentleman say about? Let's have a look.
8.
One of them is near 101 years of age.
Gonna be worse than expected.
Who's that? I have no idea. Mrs. Lisa, the only chance to productive conversation.
4.2 employment rate is better.
The eyes, or should I do the whole thing?
How will pricing have to adjust or not?
Employment rate.
Result of your greener ambitions.
Oh, way worse than expected. Way worse than expected. 210, 210. Beautiful, beautiful. Look at it spike.
PSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances.
Beautiful. Look at that. Look at you. And US 30 is going to ditch.
Rival concerts. Visit pso.org/now, where the music plays on. PSO season sponsor, Bank of America.
Market react. Here we go, everybody. Here we go. Way worse than expected. Everyone got it wrong. Closing out. These trades play out.
New York City, we are seconds away from the payrolls report. Futures up 9 on the S&P, advancing 0.2%. 8:30 Eastern with your numbers. Let's get to Mike McKee. Good morning, Michael McKee.
Good
US 30. We've closed out on gold.
Only half the level we anticipated.
Look at that spike. Woohoo! We bought on gold. We bought on gold.
Caused some head scratching at the Fed. What do we do about that? The unemployment
Amazing results.
Significantly, 4.2%, down from 4.6%.
Told you, buy on gold on the bad news. Never let us down. Look at that.
Rise by 594,000 people. So a lot of people going back into the labor force. The household survey shows over 1 million jobs, 1.1 million employed, where unemployment drops about 542,000. So you've got a good news story on the unemployment rate, but it doesn't match up with what's
Look, what do we
going on in
get?
the establishment survey. Again,
Got 4 positions on that, I think.
31,000 of those are manufacturing payrolls. Average hourly earnings come in lighter.
Got 200, 300, 400, 500, about $600.
Is at 34.8. The one everybody wants to see is the labor force participation rate, and as you can imagine from the numbers I gave you for the labor force, it does
6 minutes.
significantly to 61.8 from 61.6. The estimation was in the middle of that, 61.7. The net payroll revisions for the month, and then I'll let you check the markets here. September revised up by 67,000 to 379,000, and October by 50,000 to 546,000.
US 30, look at US 30.
Revision higher in the previous 2 months, but not the kind of revisions that we saw in the prior month.
Early days, Michael.
You had to sell it.
Knee-jerk reaction in this market. This is how we price this market off the back of these numbers.
Now what's to push back up again? Manipulation time.
To session highs, positive about 19, 20 points, up 0.4%. But just look at the yield curve now. This bid snaps into the belly of the curve. 5-year yields come in 4 basis
Look
points.
at that.
2-year in about 1.
Ooh, unemployment rate.
Down a basis point, but the big rally here is through the front end into the belly of the curve, Tom, through to 10s. Yields rallying there as I imagine we're adjusting the rate hike debate a little bit, but I just don't want to draw conclusions off the back of this too much, Tom. Big downside miss on a headline number. Low estimate was 375, medium was 550, high was 800, actuals 210. But when you look at the unemployment rate, Tom, and participation, it's a really interesting labour market report outside of that headline number.
Gold was spot on. That, there's the drop on the over. Then look at the news. Look at that, pushing up, perfect.
And I think this is a concept that people
Gold is profiteering from this perfectly.
said the labor force went up, but non-farm payrolls disappointed. Most of our listeners and viewers are saying, huh? How is that?
Well, that's why you guys are going to have some semi-professional economists on later on the show to explain it, because I can't explain it off the top of my head yet.
Again, let's see if we can get some more scalps on that.
The household and
Look,
the,
changing around.
establishment surveys, and it's kind of hard to know why, if that many people were out looking for work with that many job openings, they didn't get the job.
Got another.
Pass on some other news though that will bear
Another $100 there. We've got 60 and 23.
They're looking to improve the unemployment rates for minorities and
Focusing on
the black
gold at the moment.
6.7% from 7.9%.
The retracement. Going to catch that retracement. Remember to sell at the top.
Unemployment rate.
Watch this push, and then it's going to push some more.
From 5.9%.
Yes.
Significant
Too tempting.
there. If
We'll
you
load
look
up
at
again.
this report, just in terms of what the
Push.
Fed said, and you left out the headline number, you'd say this guarantees a faster taper. They're reaching their goals. The question is, what happened to the people getting jobs?
We're starting to see a
Up into that neutral zone.
I don't care what anybody says. We're starting to
Fine on the dip.
piece together within the mystery, as McKee says, of two separate labor reports. And I'm sorry, you've got an equity market lift.
You've got a lift, Tom. We're up 0.4 on the S&P, on a Nasdaq up 0.6%. The focus quickly went to the yield curve, Lisa, to the belly of the curve where we had a rally, but we've given some of that up now already. Off the back of the headline number, there was Mike McKee stresses, Lisa. It's important. If you stripped out the two,
Yeah, on that, yeah, we've got some more positions there. Just close another buys on the gold.
It's a terrific report. A 4.2% unemployment rate goes back to February 2020.
We've got another 4.
How low the jobless rate really is. If you look at participation, people are coming back in, and this comes.
The first 15 minutes is what it's all about.
De-emphasizes, to some people at least, the employment report. I mean, honestly, Michael, just to wrap things up here, isn't this in the Fed's eyes?
Is that spike? Look at it, it's going to push up for more. Switch to US 30 and just see what's going on with 30. Going to drop.
We see professional and business services adding
Poking at RSI now. Look, this looks good. Well, hit with gold. What a great result, though. It came out perfect. We got the move was just the news came out just the perfect timing. We're doing 1, 2, 3, 4, 5, 6, 7, 8 positions on the gold, all winners on that. And there were 87, 126, 143, 91, 60, 23, 26 and 34. 8 positions in total. We didn't take any positions on US 30. I just like to focus on one particular thing.
Employment, according to the Bureau of Labor Statistics, in leisure and hospitality is down by 1.3 million still.
What a spike. That's one of the best spikes I've seen.
Back into the labor force, and the jobs
NFP.
they are qualified for don't exist. Maybe restaurants and bars going out of business.
We got a lot of questions about this one, Mike. Thank you, sir. Often with payrolls, the first move is not the move that sticks, and that might be true of what's happening in the front end.
All because of this.
The rally that came in. Twos out to the belly of the curve.
Look at that. Way worse. Look at that amazing result. It had to move the market. Again, if it's just like, 520, whatever, but when you're talking that 210, the only saving grace was an employment rate. When it's that big a difference.
A lot of people parse this.
We got it totally wrong.
Portfolio manager of systematic quality strategy fund at BlackRock. Jeffrey, when we get ambiguity like this, what do you do?
Well, it's a really interesting report. I think you guys have broken it down well. That it may not be so ambiguous when you look behind the headline. The headline is the disappointment on 210, but as Mike McKee just went through, a lot of that looks like seasonality and the impact of seasonal flows coming in.
I love it. Always people try and justify the bad news as good and try and bullshit it. It's so funny. Trying to see the good in it. They put the good news in there. Look, manufacturing payrolls rise 31k in November.
What Lisa talked about, which I think is the much stronger
We got
message here, the decline in
the open to come, and then we're going to trade the market composite and the factory orders as well. All coming.
This is the strength of the underlying labor.
It's good to watch this, lot. How people like this talking. So it's good, it's good news basically, isn't it?
Disappointment is spot on, and that's really the bigger message. And Tom, to your last point, I don't think this report really changes anything from the Fed with regards to the labor market, but it is obviously the cross currents between the headline and the underlying components. I think the underlying components here are much stronger.
Jeff, we've got to talk about the Fed. When they get together on the 15th, it's not just about the taper conversation. Let's discuss their forecasts. Year end next year, they've got unemployment at 3.8%. Jeff, we're almost there. We're at 4.2. How much of an adjustment do we need to see in a couple of weeks?
Yeah, so all looking positive when really they've got it wrong. They've got the news totally wrong. No one predicted that at all. No one was talking about, they were talking 350 as a low, not 210. Only the unemployment rate dropped, and that's why they're picking up on the good news, better than expected. Still, we can compound the result with the market PMIs next. Well, let's get ready for the open, because on the open we'll go again. We'll catch the drops this time. We'll switch to US 30. Let's hope this stays here and we'll catch the drops. So if you are holding, if you did sell US 30, hold it. at the moment, because look at price action. You want it to break above here to get out of any trades. If you're selling, you went for the sell on US 30, which you should have caught it with this. Look, there's the spike down. Look at that. A bit in on here. That was where your entry point was. You went for a sell. I didn't, like I said, I just focused on gold. Then you would have bagged yourself. Look at that. 500 points.
It's hard exactly to know what's going on
So
there.
NFP is perfect. There was the sell, even though you're seeing a buy reaction. Moment manipulation. On the open, we're going to sell. We want this to kind of range and continue. Say as it is, stay on this heavy resistance and come down on the open.
Employment cost index. What you end up seeing is, a measurement of two things. What's the change in who's coming in and out, and what's the change in what they're getting paid. And so when you have more lower wage workers entering the pool relative to higher wage workers, it can push down what you see in average hourly earnings, even if what we think of as kind of a fixed pool of workers, wages are going up. The message on those fixed pool metrics have been
great for gold. Really, really good.
That we're seeing pricing power come back to wages, and I don't think this
post on my result.
average hourly earnings should be overly interpreted as kind of.
That's great to get 8.
I think it's still a strong labor market.
8 trades off.
Labor market pricing and wage inflation.
50 minutes away from the opening bout stateside. Futures up 18, up 0.4% on the Nasdaq. Nasdaq 100 futures up 0.6%. Counting down to the opening bout, we'll be catching up with Mohammed Al-Arian, Rick Reeder, Mike Collins, and Anastasia Amoroso, Tom, to really break down this jobs report and get first reaction as well from the White House in about 50 minutes time.
No, the reaction as well of a market lifting up. I note the NASDAQ 100 after all this up 0.6%. And the VIX is a key statistic for me, really escaping the 30 and 28 level into 26.18. Again, Jeffrey Rosenberg with us with BlackRock. Jeff, I want to talk about systematic and your responsibilities at BlackRock. And I don't care about systematic to 12/31 or even out into January. How are you managing and allocating capital out to the middle of next year, say the July 28th Fed meeting?
Not bad. 5 minutes of scalping.
Yeah, this is a really good question, Tom, because what we're really debating is, the bigger picture away from today's report is the Fed is talking about accelerating the pace of tapering, which is so that they can accelerate the pace of tightening. And markets have priced that in, so a lot of that changes with us. The bigger change that we all have to contemplate is the impact on real interest rates. You've had a spectacular level of support for asset inflation across all markets, whether they be financial markets or otherwise, from exceptionally low levels of real interest rates. And the Fed is basically
US 30 look, pull back. This would be nice. Well, ideally, I don't want it to pull back too much. Gold now, look, it's going to range for a little bit. And we might get a boost back up again on the open, because obviously gold really wants to get back to 1800, and it nearly did with that spike, look, 1778. It's still bullish at the moment.
And so we're looking at, where are their vulnerabilities and where are their opportunities in a rising real rate environment.
I just want to point out that as we speak and as traders parse through this report, 2-year Treasury yields have turned positive on the day, I should say. Once again, 0.6171%. People assessing the underlying components here and seeing a very strong report. Jeff, with respect to how many rate hikes can this market withstand and not be disrupted from a risk asset performance perspective?
Really great question, because look at what the bond market is telling you with this massive curve flattening, right? So it's a very clear message from the bond market that it can't.
We all come into this world with potential, and the more of it we can tap into, the more we can do. That's why we design ETFs to unleash the potential in investors, so they can pursue whatever goals they set for themselves, no matter how ambitious. Get your share of progress. iShares. Invest in something bigger.
That the market, financial market conditions tightening, the impact of rising real interest rates just can't handle as much of a normalization of interest rates as the kind of full trajectory of Fed normalization and dot plots otherwise would say. And that flattening of the yield curve, is a message that we should pay attention to. It's basically saying as you move into an aggressive Fed tightening policy, that the impact is going to slow the economy, tighten financial conditions, and is a warning of a recessionary indicator. Whether the Fed goes there, we'll see, but that's what the bond market is saying.
Okay, I agree the bond market's saying that, but very quickly here, Jeff Rosenberg, as we move on to the equity markets, the ambiguity of today's report, does it change the path or the belief, the cadence of taper to tighten?
I don't think it does. I think that, and as Lisa just highlighted, the turnaround in the 2 years, I think the market figuring out that this isn't gonna.
Now you can see things just range a little bit. Oh look, just holding its position, bouncing off. So again, we'll look to take buys on the open and sells on US 30. Look, just a little bit. So we'll just keep an eye whilst we watch for that. Ooh.
It's kind of the next phase. We've priced in basically
everything that they try and predict as positive law increased to 10. What they're not saying is they screwed up. They didn't get it right by a lot.
More worries from the Fed on inflation and
Always the manipulation with the news to look out for.
Before we get there.
Jeff Rosenberg, thank you so much for the treatment this morning on this jobs report. Lisa Bramwitz and Tom Keene, we welcome all of you on radio and television across this nation. An ambiguous jobs report, that according to Michael McKee, and always unambiguous. Gina Martin Adams joins us now, Chief Equity Strategist, Bloomberg Intelligence, on these equity markets. What I see, Gina, is the sweat of the week, the Omicron fear, with the VIX of 30 a touch, and we're back down already to 26.24 and 1.71 big VIX points this morning. Is this another vote that corporations will adapt and we need to own shares?
Well, I think it's all in perspective, right? A VIX at 26 is usually affiliated with a market meltdown. I mean, normally when we have a VIX above 20, we're in a period of massive correction in markets. But considering where we've been, where the VIX was at an all-time high back in March 2020, we're still seeing the VIX correct. We're still seeing volatility sort of normalize over the longer haul. I do think the market is increasingly comfortable that the economy has finally reached escape velocity. That's part of the 2021 story, is we do feel a lot more comfortable that we are going to see more persistent, more consistent economic growth going forward. The big question now is not necessarily how does the economy react to the variant, which has certainly created some short-term volatility, but really what is the Fed going to do? How fast is the Fed going to tighten? What is that going to do to rates? And how will rates then have a snowball effect on valuations in the equity market? Because we have seen valuations accelerate precipitously over the course of the last couple of years, reflecting that extremely easy policy, very, very low level of interest rates, and very steep yield curve. So I do think going into 2022, it's more about rates. While we get a little bit more comfortable that economic growth may be choppy, certainly slowing from the pace at the start of the recovery, but very consistent still into expansion from recovery.
All right, Gina, given the fact that we now are pricing in 2 rate hikes for next year, and it seems like this labor market report has not derailed those expectations, has the equity market priced that in, or are they just sort of in a wait and see mode, hoping that maybe it won't be as significant as the market's pricing in on the bond side?
Yeah, so it's more than just rates. I think the equity market, frankly, is looking more exclusively at what's happening with the balance sheet first. And this is really consistent with the experience of the last cycle. There are several stages of Fed tightening that we've got to go through. The first is we had to contend with the idea that, okay, the taper is coming. That was part of what we experienced in the September correction. Now we're going through the process of the taper may be faster than we had expected into 2022. That's
What's going on? So
we have yet to get
US 30 now selling. Here we go. This is really good. We're getting on a sell on this.
Point of greatest risk. We still have a period of liquidity.
Push down a little bit more, I think.
Missing from the conversation.
A minute. You sell before because we've still got 40 minutes.
It just means they're filling it less quickly going into 2022. So that is supportive to equity market valuations as long as the bond market doesn't react in a vicious manner. Coming midway through 2022, we get to our most critical point in time when the taper ends and we start to see rate hikes. I don't think the equity market is thinking much about the rate hike scenario, given we've got so many steps to go through in the interim.
Meanwhile, markets are a discounting mechanism, which is why you really emphasize the unknown of the bond market reaction. I'd love to get your take on what Bank of America's Romanian was saying, that basically at a certain point, if we start pricing in 3-4 rate hikes the next couple of years.
2 sells there. We've got 55 and 33, so it's 8T. So
on the S&P 500. Is that a compelling argument against the move much higher
closed out.
in the index?
2 sells there. We're in and out on US 30.
In the index, certainly, because you start to see a very different economic environment if investors are starting to rotate out of equities. I think, frankly, that's a long way from where we are today, and certainly not going to drive stocks in the next 6 to even maybe 12 months. You know, the dividend yield on the S&P 500, albeit still around 2%, still a far cry from where we are on the short end of the curve. So I would say it's a bit of a stretch to suggest that we're going to price that in imminently. It may be something we contend with at the end of 2022, early 2023, as we're looking into 2024, 2025. But it's just not the story for me for early 2022.
Gina, thank you so much. Look forward to publishing Bloomberg Intelligence over the weekend and into next week. Gina Martin Adams running our equity shop. Michael McKee during
I'm saying I'll probably pull back a little bit more. It might range a little bit now. I just wanted to catch that wick. It did. Just because it broke our average line. It didn't go red. Would have been ideal. But we'll keep watching US 30 because gold, look at that, pushing down more on the sell now. Wait to get some buys in on this when it pulls back once RSI comes again, so we'll just hold that position. What happens on, you know, you get the NFP result, you get the market moving that way, and then you get the counter move, which is what we've got now. You know, usually pre-market we would have gone for the sell straight away on NFP. So you can see here is the bottom of the candle, and if you put a sell in, well, you'd be in profit now, but you've got to take all this drawdown, which nobody's going to do. So, whereas most of the time with gold, we will go with the news. Obviously, with NFP, you go against it. We did. Then it pulls back. So we'll just wait to load up buys here, wait for RSI to come back into a neutral zone, and then take the buys back to our breakout zone. So we can EP1 to here.
One more question, Mike, before we get to Ira Jersey.
This is where I'm anticipating some kind of pullback. Not yet. This might drop a bit more. Our initial the news was better than expected. Wasn't, obviously. Clipped that and bounced off it. If it breaks this, then we can probably get sells in. This is just what I think the bigger picture is going to be on the open. More buys, and we want this to drop. Pretty good.
That it's hard to compare anything. They usually take 5 years worth of seasonal numbers. But last year's numbers were so weird that it's hard to do.
To me, the math doesn't. I can't get there, Lisa. I just can't get there given a pandemic. When I hear 700,000 jobs are created, that floats on my boat. The VIX down 1.53, 26.42. Futures up 12. Lisa?
Yeah, and I'm looking right now at the front end of the yield curve, basically 2-year yields rising to near the highs of the year, 0.631%. I am curious also about Michael McKee's idea about healthcare workers dropping out. I do wonder about the analyses of the vaccine mandates and how that affected certain employment backdrops in specific areas. Right now, though, let us really hone in here on the Federal Reserve reaction function on the bond market, which has seen that yield curve flattening persist despite the sort of momentary blip. Ira Jersey parsing through it all, Bloomberg Intelligence Chief U.S. Interest Rate Strategist. What was your first take from this report?
Yeah, hey, Lisa, obviously that headline employment report, you know, that was why we had that knee-jerk reaction where you had 5-year notes and kind of the belly part of the curve, which is pricing for the Federal Reserve's terminal rate, so how high they'll ultimately hike interest rates during the cycle. That all rallied, but has since come back. And I think, you know, some of the things that Mike McKee and Jeff Rosenberg were talking about a little earlier, this report really was not that bad. So if I take in aggregate, look at aggregate labor income, which is the number number of jobs created times the amount of hours that each employee is working every week times hourly earnings, what you wind up seeing is we're back to the pre-COVID trend right now. So so basically the economy and a lot of the things that we look at in the economy have returned back to 2019-ish kind of levels. So because of that, that is a reason why I think the market's still thinking the Fed is going to taper a little bit faster. The market will probably price for earlier hikes even than what we're pricing right now. So we're still pricing a full hike in June of 2022. The question for me is, will that be realized? Because there's a lot of uncertainty still in the economy, and with Omicron and everything else, that maybe the Fed, while they might taper faster, they might not hike very much faster.
Do you see a conflicting message, Ira, both in the market basically goading the Fed on to hike rates, basically the Fed adapting to the market's view, and this flattening yield curve, which seems to indicate, as some people have mentioned on the show today, a policy error?
Yeah, it's kind of weird. So I think that the chair getting hawkish over the last 2 weeks or so has really changed the market vernacular and what the market's thinking about. So the market is thinking that, hey, if the
US 30 now, look at that, see, rebounded. Why? You just got to nip in and out because you're still in a long bull market, 87%. It broke out the baseline, didn't break the trend line, didn't go red, didn't break out the neutral zone. Everything to say that if you are going to trade a sell like I did, just get in and out, get a bit of green and get out again. Don't hold because you're going against trend. And on the open, we want to catch the bigger sell off this resistance level.
I suspect that we might only get like one hike every.
Gold now, look again, doing the same thing, rejecting and pushing up.
And then eventually we'll get into a more normal cadence and
see if we can clear the wick and get a buy in on this as well. Let's have a look.
The market is certainly not priced for that.
I think you're just dead on this. I just think, folks, this is so important to understand that.
Right. Let's see if we can up. 46 on the neutral zone. Wait and see. Price action's gone red. Dropping back. 44, 43, 44.
So, yeah, it's everyone seems
touch
to
our average line. As you can see inside here, look this.
Either you're in the transitory
out, we're done, we're in and out, quick.
2.5% inflation in 2 or 3 years, which, by the way, the market is still pricing, or you think that inflation is going to remain significantly higher than it has been. And I think the idea that we're going to have continued 6 or 7% inflation, as someone mentioned to me yesterday, I think that that's very unlikely, just because you have a lot of base effects that are going on. But imagine a world where you're somewhere in between that, right? And this is, I think, the kind of more realistic.
43, come on, give us a push. Give us a little boost on the open. Remember, 2 p.m. Well, 2 p.m. my time, London. 9. Always some kind of little movement, half and 30 minutes before the open. And let's see what we get. We're going to be looking for more sells on gold or looking for buys. On the open, we're looking for buys. Let's say we're 30 minutes away. Just going to see if that wick is going to get filled and RSI is going to get back into our neutral zone.
Ira, thank you so much.
Zoom in if you want.
Some final thoughts this morning as we move from Gina Martin Adams and her
So interesting to watch
to Mr. Jersey
in action.
Lisa, I love that idea that there's a polarity of opinions.
Goes 44.
To the in-betweenness of it all.
That's where the Fed's going to try to stay as they try to both dovetail the political emphasis.
Get a trade here, we're just going to be in and out again. Quick scalp.
To run hot. I think that if we just take a look, if we broaden out here, the takeaway
44.
was this was a big headline miss, but it was a big win when you look at the underlying components.
Okay, it wasn't a big win. It wasn't a big win. I love it. I love it. They're told what to say. It's amazing, isn't it? It was a big win. We got it wrong by 300,000, but it was a big win in the underlying. What about the underlying of your lying? I love market manipulation. It's great. I love Bloomberg. Yeah, these guys are basically told what to say.
To withstand it. And Lisa, the drawdown of all the angst of this week, I can't believe it's been a 5-day work week. Extraordinary. Lisa, the maximum drawdown here, a negative 3.46% on Standard & Poor's 500.
You know, yes, it's been volatile, but it hasn't really been that significant with respect to the actual moves. How much does this give the Fed confidence, right, that they can go ahead versus has the market not really
US 30 pushing up on that. Say we're looking to take this as tricking you. I'm going to take that sell on the open. 44 gold. Give me 45. Give me 46.
As well, certainly a constructive spin from the White House this morning. Futures up 18, Dow futures up 113. Please stay with us on radio, on television. This is Bloomberg.
Seen the divergence as well, look. Bearish divergence. Yeah. 1, 2, 3, 4, 5. Bang. So. That's how it works with it. 1, 2, 3, 4, 5. Down. It's not what I'm saying it's every time, but just the indicator is X, and if you want to trade divergence and get in and out on it, thing to look for. You get as part of the setup. And I just count 5 and then you enter the trade. That look. 1, 2, 3, 5, down.
Next up, December 15th.
Bearish. 1, 2, 3, 4, 5, buy. Pretty good, pretty cool, pretty cool. Okay, we go. Gold's now more volatile again. It's great. I say we're not doing anything at the moment. We were looking to take a buy if we got back into that zone. Hasn't happened yet, so we'll just hold fire. Gonna hold. Want, you know, gold to get back to 100 level.
The potential for this accelerated taper.
So much manipulation to keep gold below that level. The high 1781.
There's clearly more pressure on the Fed to act now.
The next step will be at the December FOMC meeting.
And the countdown to that begins right now. We can do that with BlackRock's Rick Reed.
This is our TP we're aiming for, ideally. RSI 41, so no panic. We're still looking for sells on US 30, buys on gold. That's the current situation, so we just sat waiting. And this is the thing, there's a lot of waiting on the 3-minute time frame that people don't appreciate. Plenty of time. You don't need to trade a bigger time frame. There's plenty of time to do what you want to do and still trade.
Relatively contained wage growth, sharp declines in minority unemployment, and let's not forget,
really, look at that candles, beautiful. 20 seconds to go on it. Nice rejection off our support zone, look, as you can see. So 3 taps on that.
It's giving a very clear signal. It says to the Fed, go ahead.
So really, you can see it really wants to try and get back.
The economy can take it.
Nothing here to stop them. You strip out the 210. Rick Reader, you take away 210, and the rest of this report looks pretty solid, doesn't it?
Boy, I think it's a good report across the board, Jonathan. I mean, the dynamics around, if you take the non-seasonally adjusted data, it's over 700,000 jobs over the last 6 months. Look at the household report. The household report was incredibly strong, over 1 million jobs. Pretty impressive numbers across the board. I mean, yes, they're going to debate the top line payroll report, but if you marry this to claims data, the JOLTS data, the job openings data, there's no ambiguity. I mean, the Fed has a window to move, and obviously they're going to take advantage
rubbish,
of it.
absolute rubbish, absolute rubbish. For his company, yeah, rubbish.
Mike McKee dropping by to get us up to speed on his view. Mike, you've had about 30 minutes on this one. Your view now?
I think you start with the seasonal adjustment factor. A very tough one for this November, 568,000 jobs. So there were 778,000 non-seasonally adjusted jobs restored, and they took away almost 600,000 of them to get that 210 number. So if you had put it in terms of 2020, a year ago, there were only 289,000 jobs subtracted. We would have had a number much closer to 500,000. Here's the other numbers that, as you can see, the unemployment rate drops to 4.2%. Over 500,000 people come back into the labor force, which pushes up the participation rate by 0.2 to 61.8%. The Fed's
and there we go. We're just going to close these positions on gold. We'd got in. We did it. Brilliant.
Getting out of the QE.
Thank you.
The unemployment rate rate for
that.
minorities, black unemployment,
There you go.
1.2%
Hit.
percentage points to 6.7%.
Beautiful. There was the buy. We've got 57 and 56 on that. So I'll just so everyone can see.
As well. So
Few nice little buys on gold there.
things that the Fed is looking for. A bit of a surprise in the leisure and hospitality sector. Only 32,000 jobs created in that whole area, and I wonder if what we're seeing is jobs have gone away because a lot of restaurants, bars did not reopen, and hotels are still not getting business. The number that Rick referenced, 1.14 million people getting jobs during the month. That's in the household survey. That's a significant reason that the unemployment rate fell by 0.4 during the month. A huge number of jobs created.
An easy
on that
one.
survey, and that's why you see this big dichotomy between
RSI told you just needed to get into our neutral zone, and then we were in and we were out.
number for unemployment. And I guess the only other thing to say about it is where's the Fed going to go from here? It hasn't pushed the markets significantly higher, but we do see almost 2 rate increases.
So we're still looking the big picture. Sales on US 30, more buys on gold.
Of next year.
Zoom out now, look, we can see that's adjust this TP live level now to. That's obviously pulled up to the neutral resistance zone, you see. There you go. So we're looking for that breakout zone again for the buy, ideally.
Federal Reserve and the pivot that seemingly we got from Chairman Powell this week. Such a late wake up to the reality of inflation increases the risk of mismanaging
Break our trend line crosses.
Exposing the economy to a higher risk of an unnecessary.
And that's going to be a potential of another 250 points.
And reflect on what you heard from the chairman.
It's pushing up, comes out of the neutral zone, goes green. Guess what we're doing? We're going to buy.
I think the market pricing is consistent with this.
I'll watch that and reject off the blue neutral resistance at 108.
The ground forced you to go faster than you would normally want to go. And if you go faster than you normally want to go, you risk breaking something.
It's 30. Yes, perfect. Perfect. And a double tap on the top. So I'm more convinced about this now. Obviously, I'm going to take away that. Have that as the number 1. We'll have this as
and that's the problem of a
number
high
2.
leverage economy, is that if you are late, you risk making a policy mistake.
I'm thinking, even if the market retraces and goes back up again, like it did on NFP, look, on the result. They're saying it's hawkish, they're saying, you know, oh, the underlying it's good news, and seasonally adjusted figures, and the unemployment rate, and blah, blah, so they're almost talking the market into pushing up. But we know there's going to be a correction on the open, because everyone's going to be looking to buy for listening to Bloomberg. Let's try and catch any kind of retracement, 100 points. Look how much green there's been on the chart. The average now is 63 for the RSI. That's the average it's been at.
Earlier, faster, why not higher, Rick? Why is there this belief that if we start
So
next year, ultimately rates go to 175 and that's your lot?
So, Jonathan, I think it goes back to, you know, what is potential growth of the economy? Listen, I mean, so if you go back, I mean, the numbers are pretty staggering. You think about if you take nominal GDP this year, Jonathan, if you take what we're going to get, we could get 11% nominal GDP, real, actually almost exactly split, real and inflation. You're going to decelerate next year. But by the way, it's still going to be strong. I mean, I think the numbers, you can get a 7-ish nominal GDP. So let's say that's 4 real, 3 inflation, if you assume inflation comes down a bit. So now, but then where are you going after that? And to your point, you know, I think potential growth of the economy runs it in and around 2%. We've had massive monetary, massive fiscal stimulus, and we're coming off the backside of that. The tricky part about the Fed being late, and, you know, we've talked about this for a long time. They should have moved earlier. The tricky part about being late is you have an economy that's coming off the boil. You're going to have to, there's going to be this, how fast are you on the gas pedal, or I guess probably the brake, about how much you want to move in an economy that's probably
20 minutes to go till the open. See how our price action shapes up. See if US 30 just holds on this resistance. So it's going to break it, look, the breakout line, or coming down.
What the market's telling you is the liquidity is so big and the natural demand for yield is immense. And you watch that play through the markets every day.
Yeah, I think this is the important conversation. It's not liftoff. It's about how high they take interest rates, how much work they need to do. It's been fascinating for me, gents, to hear from the Federal Reserve officials that are leaving the Federal Reserve, who are starting to say maybe what they really think. Take a listen to what Governor Quarles had to say on what the Fed's got to do.
And I think that's entirely consistent with saying we're going to wait to see the whites of their eyes. We never said we'd let the Army march over us. And so, you know, the Army is upon us, and so now we'll begin to fire.
Mohammed, this is the conversation we're having. The Army is upon us. Now we begin to fire. How much do they need to fire?
Well, he's basically saying we're late. You know, the Army is above us, and we don't want it to go over us. He's basically saying we are late. And I think what we're getting, John, is a lot of indications that within the Fed, there was a more hawkish tone than what the press conference suggested. And Priya Misra, on your earlier show, made that point, is that if you look at the press conference and you look at the minutes of the FOMC meeting, or if you listen to what the majority of people have said since, it is a more hawkish Fed than what the chair signaled at the press conference. And I think the chair is feeling a lot of pressure because people are worried. They're worried about the anchoring inflation expectations, and they should be. I think Rick and I have been saying for months, they are late, they are late. Be careful, because you end up with a high risk of a policy error that let's
nice.
It's not about markets as much as it is about the economy. It's about an unnecessary damage to the economy and to livelihood.
And Mohammed, you've been making this argument now for months. There is a degree of difference, though, that I hear sense between you and Rick this morning. Rick believes that, yes, liftoff, sure, they're behind the curve, they need to do something, but ultimately they can't do that much with interest rates. They can only take them so high. Mohammed, you and I are familiar with that argument from the former New York Fed President Bill Dudley from earlier this year. We had that panel together, and he made the argument that if they wait too long, they'll have to go, and they'll have to go higher than people in this market expect. Are you one of those? Do you agree with Bill Dudley on that?
No, I mean, I disagreed with Bill Dudley at the time. I still disagree with him because the economy cannot support the 4 to 5% that he at that point saw as a destination. I don't think we can get there, John. We have a highly levered economy. We have a marketplace that has been wired for not just an incredible amount of liquidity, but for low interest rates for a long time. Put all that together, this is not an economy and a marketplace that can sustain 4 and 5. So on the way to 4 and 5, things start breaking. So that's the problem. That's why it was so critical to start early, so that you don't have that high risk.
Gold still moving, US 30 still moving. Quick look, yeah, gold in that range.
In 22, what have you been doing, Rick?
So, by the way, I'll go back. I think Mohammed described it exactly.
Like the neutral resistance is going to be our zone.
Things can break, and when you're late, you've got to think through that from an investment paradigm. What does that mean? The first thing that has to happen, the Fed needs to exit this QE business. And you question how far they're going to go or how much they're going to go. They need to get out of the QE.
So you've got 15 minutes, right? I'm just going to go put some more coffee on. We'll be back in 5 minutes. Get ready for the open.
More liquidity into the market. That is crazy. So they need to get out. So, but what you have to do when you invest, you have to think about, gosh, we're now going to be in a lower liquidity period. We're now going to be what is going to be a more uncertain period. Quite frankly, there's an awful lot of patience that you need to bring to the equation. We've been doing that in portfolios. And so, you pull back on the high yield market, you pull back on how much equity exposure do you have, and you got to be a bit cautious. You run higher levels of cash today. And then you look at areas, exactly like Mohammed said, there are areas that are now starting to come unglued. If you look at what happened this week around some of the tech stocks, some of the software companies, and by the way, some businesses that are really good businesses that all of a sudden you have crowded trades in, people have to get out. That's the time you invest. So we're doing much more opportunistic investing, and I think you got to be a bit more careful than when you had immense liquidity in the system, a huge tailwind of growth, and now you just got a little bit of patience, a little bit more cash, and then be more opportunistic.
Rick, let's continue the conversation. Rick Mohammed, sticking with us. Coming up on the program, the talk of the town down in D.C., Omicron. That's next.
The key thing is going to be how the variant and in particular policy responses to the variant come out.
From New York City, this is Bloomberg.
market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
We're expanding our national booster campaign to provide booster shots to all eligible adults. Our docs and scientists believe that people who get a booster shot are more protected than ever from COVID-19.
The president unveiling his winter COVID strategy and expanding access to booster shots. This coming as lawmakers passed the stopgap spending bill late last night, with Senate Majority Leader Chuck Schumer saying the following: with this agreement, there will be no government shutdown. For more, let's head down to Washington and catch up with Joe Matthew. Morning, Joe.
Morning, Jonathan. It says a lot about where we are here when we're celebrating the agreement, the passage of a continuing resolution that simply funds the government through the middle of February. But that's where we are here. And to your point, President Biden speaking about the new variant, the Omicron variant, and I do want to just add a little bit of measure here. I hate to be the one to lay on more uncertainty, but the jobs numbers you are talking about, of course, are very much dependent going forward on what happens with this variant. The president did speak about it yesterday, rolled out the speech that we discussed, Jonathan, around this time, and he made good on all of our expectations, even adding a couple of details: an increased booster program, more at-home testing that he says insurers should be covering by January. That was a little more detail there, and a big effort to vaccinate the world. But I will add, that speech had no specifics about the new variant. In fact, it frankly could have been delivered before we ever heard of it. A lot of questions about where the next jobs report is going to be, Jonathan. It was only a couple of days ago that this market was staring over a cliff on concerns that Omicron would keep more people from returning to work and could prompt more inflation. So this is something we'll be listening for today. I suspect Labor Secretary Marty Walsh may weigh in on that. We do expect, by the way, to hear from President Biden on today's jobs report a bit later on this morning.
Secretary Walsh, 13 minutes away. Joe, thank you. Good to catch up, sir. Looking forward to your coverage a little bit later. Back with us, Rick Reeder, Mohammed Al-Arian. The upside risk, the downside risk around this variant. Rick, the outcomes are still incredibly wide. Morgan Stanley's Ellen Zentner said this to me this morning. The risk around Omicron is that they have to hike earlier, not later. Rick, we don't have the data to draw conclusions right now. As you look at the range of outcomes, how wide are they from your perspective?
So, I'll tell you the tricky thing, Jonathan, with this variant, and that is, I think, quite frankly, a bit more concerning than some of the others, is the transmissibility of it is significant, and we don't know the answers yet. We won't know. My sense is the severity is not that significant, but we don't know the answers for the next week. So why you're seeing this unbelievable illiquidity in markets. I mean, I haven't seen the markets this low convicted in a very long time. What do you do with it? By the way, the thing I think their point was right. If you think about this, if you have this increase in transmissibility and you have to have some shutdowns, you introduce a longer extension of the lockdown and supply chain dynamics that do create a bit more inflation. It's interesting. The market this week, we're battling back and forth between lower growth means lower inflation. I actually think at parts it was actually misguided, because if you do, which I think Ellen said, if you do create this dynamic, what's really impacting inflation today is supply. And if you shut down supply again, you create what is an accelerating problem around inflation again.
You talked about the disconnect in this market as well, and Mohammed, I'd love your view on that. This has felt like a really ugly week. We're 2 or 3 percentage points away from all-time highs on the S&P 500. Mohammed, I just wonder, from your standpoint, what you make of that. It feels really bad. Yet when you look at the price action, is it?
Well, I think that Rick was absolutely right. It's an issue of liquidity. So you get a lot of volatility, but then you look back for the week as a whole and you wonder why it felt so strange. John, there's another element, is that we are still getting a lot of information out of South Africa. And I must tell you, I am getting more worried. I've talked to quite a few scientists, and there's complete agreement, as Rick said, that this is a much more infectious variant, much more than Delta. And we know how bad Delta is. There is still not enough data to suggest, is it vaccine evasive or not? Some scientists are really worried about this and they can go into details. Others are saying, let's wait for more information. And therefore, it's not clear to us where those hospitalizations are going to go. So we're going to learn a lot from South Africa over the next few days and weeks. In the meantime, we're seeing another effect that markets have to deal with, and they haven't yet quite understood is going on: enormous dispersion in government reaction. You're getting mixed signals domestically, which means expectations are all over the place, and you're getting different approaches internationally, which means that you can't have a common response. Bottom line, I don't think it's a big issue for demand overall. It's an issue for the composition of demand, but it is an issue for supply. And as Rick rightly said, it will make supply chain issues persist for longer, and it will make labor shortages persist for longer.
Mohammed, I want to pick up on that point about geographic dispersion here, just in terms of the reaction function of policymakers in, say, Europe, China, and the United States. Rick, does that shape how you allocate money from a regional perspective? Europe versus China versus, say, the United States?
Wow, that's a great question. I mean, so you have to think about the short term and the long term. I mean, from a short term perspective, you have to think about what the shutdown potential is. I would, from my perspective, it's more intense around sectors. So you think about today, gosh, if we're going to create a shutdown, gosh, do I want to own a lot in the travel sector? I got to be a bit more careful on energy commodity. Regionally, listen, I think the U.S. is going to grow. I think the demand function in the U.S. is ingrained in the system today and will continue to promote itself through next year. I think Europe's a bit trickier. I think China, listen, the slowdown in China is a place you want to be a bit careful about the regulatory evolution. So, we're staying much more cautious there for the time being. So when you boil it all, by the way, emerging markets is clearly uncertain around the growth response around inflation dynamics. So, we've had a heavier intensity around our U.S. exposure, and we're going to keep it that way. But then also, by the way, there are parts of Europe we talked about on your show, European banks, which, by the way, I think are pretty interesting again, because they came under pressure in the last week or so. But I would say sector more prolific, but definitely with a heavier orientation towards the U.S.
Mohammed, final word for you, sir. Conviction trade right now, what would it be?
I think what Rick said was absolutely right. Favor the U.S. over the rest of the world, and be very careful about sector allocation, and within sector allocation about airlines. Look, in airlines, I'm okay with an airline that flies domestically. I'm less okay with an airline that flies internationally. And the final thing, political risk. We don't talk much about it, but political risk is becoming a bigger and bigger factor for international investors.
Gents, always feel lucky to catch up with you guys after payrolls. Appreciate it this morning. As always, Rick Reeder, Mohammed Al-Aaron, your payrolls report, 210,000. The downside, a miss from an estimate of 550. Elsewhere, though, this Labour report pretty decent, and we need to discuss it with the White House. Reaction first from the Labour Secretary, Marty Walsh. That's just around the corner. Your morning calls are as well.
So I think for too long, wealth management has just been for the wealthy. And what ETFs have done is they allowed us to...
We're back. We're back. Here we go. Let's get ready for the open. Everything's looking good. US 30's poised, look. Where our TP's going to be. Where do you think it's going to be? It's going to be on our flat KG line. There you go, look. That's what we're looking for TP1 and TP2. Just about there. Bang. Let's see if we get it. And on gold, yeah, ranging. We're looking for that push up as well. It might not, it might go the same way, so just be careful on gold. Always a bit more dodgy on open. But US 30, I want to be taking a sell. We've got about 5 minutes before we enter a trade. We enter trades just before the open, obviously. All good. Let's just load up. Our brokers ready. Yep, what's Bloomberg saying? Nothing at the moment. Look what the latest is on investing. What's a nice coffee? US jobs growth slowed sharply. Look, here we go. So at least investing.com print the genuine news, as opposed to the manipulative news on Bloomberg and all the other channels and stuff and everything, you know. So Jobs slowed, you see. Employment rate, yeah, fell, yeah. Yeah, exactly what we want to see.
5 minutes away from the opening bell in New York City this morning. Good morning. A lift in this equity market. Equity futures up 0.4%. The Nasdaq up about 1/3%. That's the price action in the stock market. Here are your morning calls. First up, we begin.
Futures up. Oh, I'm going down.
The analyst highlighting the
Morgan Stanley. Okay, Citigroup. They were all good. We've got 2 minutes to go before we enter some trades.
Tough year after earnings fell short and a number of metrics were down there big time. Negative 17% going into the opening bout. And finally, Deutsche Bank initiating coverage on Peloton with a buy rating. The analysts seeing plenty of upside with investors overlooking strengthening fundamentals.
Go. Started to pull down. It's fine. We've got plenty of room to get 100 points on this open. 221.
The White House response. US Labour Secretary Marty Walsh joining us with his reaction to the payrolls report. The opening bell just around a corner. Futures with a lift on the S&P advancing 17. We're up 0.4% from a beautiful New York City this morning. Good morning. This is
beautiful New York City. From a beautiful London, where it's grey and wet and damp. But we don't mind, because we're about to get some more pips. RSI just poking into our neutral zone at 55, 54. Here's the flat part, which is at 48.9. So this is where we can anticipate the RSI dropping down to, hopefully, on the open. Got about a minute to go.
The world's urban areas are most vulnerable to climate change. Cities consume 78% of the world's energy.
8. All right, let's have a look.
Also generating 60% of greenhouse gas emissions. By the year 21,
yeah, just pulling back a little bit. Just wait for this candle. Look, this final candle. You can see now and why.
90% of all urban areas.
Yep, that's.
And with sea levels rising, 800 million residents are likely to be affected. 1.9 degrees to 4.1 degrees Celsius is the projected increase in urban temperatures around the world by year 2100. By 2050, 1.6 billion people are projected to be vulnerable.
Okay, there we go. Right, let's see what happens. Good luck, everybody. And let's see if we get nice movement on gold and US 30.
Bloomberg has enhanced search on the terminal.
Watch the price action. Got about 30 seconds to go.
Now,
and
type phrases in everyday English in the command line.
Beautiful on gold. I've just closed my positions on gold. Sorry already, because it was $200. So I'm sorry I'm in and out on that already. And I'm just about to watching US 30 now as well. Did push up for the drop. Beautiful win on gold. That was beautiful win. We're done. There we go. We're done. We're done in 30 seconds. Was that? So we got 3 sells on US 30. We got 37, 46, and 16. And then on the buys on gold, I got 62 and 70. 77. There we go. So done. There's the open, nailed in 30 seconds. Can you beat that for trading and scalping? I want to know. If so, please show me. Please show me. That's it. We're done. We're done.
What a trip it's been for treasuries this week. 2-year yields higher.
Done in 47 seconds.
The curve flatter. That's been a story over the last few days. The curve flatter to about 80-odd basis points. Basically, essentially where we started the year, a full round trip. This morning, yields up at the long end by about a basis point on 10s to 145.80. On 2s, up 3 basis points to 64. Just short of where we were last week at 65. What we've heard from the Fed speak today, Jim Bullard, first out the gate, repeating he favours speeding up the pace of taper, acknowledging that it's too soon to judge the impact of the Omicron variant on the economy. Let's dig into
That's all you wanted. Look, that spike, you see, hit our TP. Perfect, look. Now watch it come down. Yeah, you can hold for more if you want, but why when you can scalp and get in and out? Like that. There was the spike down.
This, of course, on the news that they are going to be delisting from U.S. exchanges and are planning a Hong Kong share listing in March. DocuSign, the worst day ever in its young life, plunging 34%. This on a debacle third quarter billings miss.
Gold, look at that. It is, look. Proof is in the pudding on that. Is straight up to our base flat line.
Another day of reflationary or cyclical value. Take a look at ExxonMobil.
Can't get much easier than that when you're true scalping in and out.
And then Morgan Stanley up 1%. Banks doing well with the small lift in yields.
No hassle.
Over at Citigroup, John.
Abby, thank you. Thank you very much. About 1 minute.
And we just made, what did we make there? We made £130, 150. We made 200. So we made $300 there on that open.
Process the rest of the report. The rest of the report actually pretty decent when you pour through it. Outside of the 210, unemployment down to 4.2%. The estimate there was 4.5. Unemployment much lower. Wages doing okay. Inflation, though, still the big story. From New York, I'm pleased to say, joining us now on TV and on Bloomberg Radio on the payrolls report. First reaction from the White House with U.S. Labor Secretary Marty.
So now, since NFP had some trades were done today,
how would you characterize the state of the labor market right now, Secretary Walsh, in the United States?
I would say if you look at what's happened since President Biden's taken office, he's dropped 2 points off the unemployment numbers. I'd say we have a strong market moving forward. Obviously, we have job openings that we have to work on, and we still have people out of work. And
there were 19 trades.
The words before I came on here, we're still dealing with the coronavirus. We're looking at the new variant now to see what impacts that'll have. But overall, we feel good. I feel good about where we're going as an economy here. Obviously, you brought inflation up as well. You know, the president made some moves this week with the oil reserves and also, you know, creating an economic plan. We're seeing people with more opportunities and more money in their bank accounts than this time last year or pre-pandemic, I guess I should say. So, you know, we still have work to do, no question about it, but I feel good where we're headed.
Let's talk about that work and the work we still need to do. As you know, we talked a lot about where wages are, close to 5%. Below where inflation is currently and going into next week. I believe a lot of people in this economy, in this market on Wall Street, Secretary Walsh, looking for something closer to 7 on CPI. Do you still see the benefits of running this economy hot, Secretary Walsh? Are there benefits to doing that as you see things?
Well, you know, one of the things I just want to talk about, this week I went out to Los Angeles. I was out at the port in Los Angeles and Long Beach. And when you think about the economy, you think about people coming back to work. One of the things when I was out there, you know, we have the
Rate spike. Said trend line reversed, doesn't matter what it does now. We're in and out, and our trading is done. And US 30 exactly the same. There was the sell. The matter that it reverses back up. It's what I said it would. I said it would manipulate. What we wanted was this drop for 100 points, and then we'll wait for the bigger sell-off later on. RSI is below our average. Look, let's see if it enters that neutral zone, we can get in for more sells.
We have to start to focus now intentionally in different sectors of the economy, so we get people trained up and get people back to work.
So this is not about a broad-based effort to run an economy hot. You think this is about specifically targeting certain sectors? Is that right?
Well, I think we have to target certain sectors now to bring those sectors back. I mean, we look at some of these numbers. Hospitality this month the numbers are kind of, I don't want to say
pushing up.
We didn't see growth on hospitality. We didn't see growth
Yeah, look.
in construction. We saw growth in construction in the sector. We didn't see any growth, actually job loss in the government sector. So we really have to start looking.
Stick with US 30 now, because obviously gold, look, you can see it's a range, bang, 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 as you'd expect now. Better just to leave this alone for the time being until it gets some kind of direction, or we hit an overbought, oversold zone. Yeah, we had the bearish divergence, look. Again, look, went from there. So let's line it up and pick it up, and then 1, 2, 3, 4, 5 candles, buy. See? Divergence, again from here, 1, 2, 3, 5, sell. Yeah, I love this divergence indicator. It's all part of the AX trading system.
Do you think that's achievable? How dependent do you think this really is on just...
So I'm still anticipating gold pushing up and US 30 coming down.
I think we have to be realistic about the labor market and look at what...
Bigger TP is obviously back up at that 17.79 zone. We'll watch for that.
People working, teleworking. We've seen 30%, I think last month, if I get the number correctly, 30% increase.
Got these composite PMIs coming out, 8 minutes. Let's do this and do the factory orders as well. And then that will be the end of our stream. It's been a successful NFP. And again, we've done over, I think we're over $1,000 in an hour and a half, an hour, 1 hour. Which is always my target for NFP. I was trying, depends on your account size, of course, but I was using a huge account today, 4,000 or 5,000. That's a good percentage, which most people will tell you isn't achievable. People who's gone about 1%, 2%. It's rubbish. Can be done with the right teaching.
No question about it. I mean, we have a lot of work to do. We have to work on making sure that we implement the unemployment
And the right system,
work that we're doing.
And you can do it more with fundamentals than you can just trade in pure TA. I think everyone knows that now.
Workforce development, training money. I really want to look at changing the way we train workers. I think we want to make sure we're training workers not just for the
Yeah. I mean, we're over $1,000 for the session, so that's pretty good.
The reason I asked, sir, it's not a personal attack. There was just some news.
That's always kind of my goal on NFP. You should be able to try and get, it could be $100 for you. That's still fine. And do what a lot of people do. I say just load a few $100 into an account and just trade the whole lot and go for it. And then if you does go wrong, you only lose that. You don't lose your whole account.
The governor and myself have a great relationship. We were partners for 6 years in Boston.
Because like some of these spikes, these NFP spikes can wreck people's accounts. There's loads of famous YouTube videos of people blowing their whole accounts. After a W though, second leg, that back. And here's kind of the M race. Withdraw this because you can see.
Take a signal from your refusal to answer that direct question.
There's no signal. I love my job here.
Secretary Walsh, we'll let you go, sir. I know you've got a busy morning. Thank you. Thanks for being with us. The US Labour Market Secretary, Marty Walsh there. Joining us now, iCapital's Anastasia Amoroso, PGIM's Mike Collins. Guys, great to have you with us. Let's work through this equity market, this bond market too. Anastasia, your response to the Labour Market Report out about an hour ago.
I think it is much, much better than the headline would suggest, John. And I think
another one, much better. Jesus Christ, I love it. Here's Anastasia.
And finding jobs, and that's exactly what we got. If we look at the household survey,
I just don't like to admit they're wrong. Basically,
million jobs that was created in that survey.
Sounds like to me half the time. But you got to learn, to read between the lines and all this kind of news and Bloomberg. And it's a very powerful thing to watch and get into and learn fundamentals, but also you can't believe everything they do and say. Not when you're retail trading on a 3-minute time frame. This is more geared up for people holding bigger stock shares, etc., etc. But we can still take the information to help guide us and give us an edge when we're trading. So that's what I'm seeing. Look, I mean that's a nice.
Was a little bit lower, right? Because these are lower paying service jobs, the jobs where we have all the shortages. So those are coming back. So this is actually a good story for a moderation in inflation. But we do have an issue with the general narrative that this is all supply induced, right? We've done a lot of work.
So this is what I'm thinking.
That the bigger reason for this higher inflation
Once it comes out this neutral zone, we're broken here and we're popping in. Said to be sells. This was just open manipulation. It dropped down, went up, caught a few people out, triggered some pending orders, which I told you is very... I do pending orders. I do a couple of pending orders now in the Asian session, but I don't do them anywhere else. And that's only because I'm sleeping. You know what I mean? It's about the only time I set a proper stop loss and preset it. And then the drop, because the news was worse than expected, no matter what they're saying.
The zeitgeist is Fed tightening into a slowdown. It will eventually, but the economy ain't slowing yet. The Fed hasn't even started tightening. Strong data for the next 3 to 4 months.
Got 3 minutes to the news.
A much more aggressive Fed and a higher terminal rate and real yields. Mike Collins, what's your response to the work of Bank of America?
Yeah, you know, they have to start moving. I totally agree. You know, do the taper. Get
The gold's pushing back. US 30 is pushing. Yeah, there we go. So it's going to be, let's see what this composite comes out with. You know, with the higher, again, it's looking to drop. 56 over 57, 57 and 58. So it's worse than last month. I want it to be, you know, like to be 55, 56, and then we'll get more sells on US 30 and more buys on gold. Perfect.
Quickly than people think, and inflation is going to be coming down. So the Fed has to be really careful. Yeah, they should lift off.
Ready, set.
Get funds rate to 1%, maybe 1.5%. But I think that's it for the cycle, and that is what's priced in. So the markets are kind of on sides with that view right now.
You're in line with Rick Reeder, with Mohammed Al-Erin as well. They believe the same thing. Anastasia, a final word on you and on that. It's a really important conversation. It's not about liftoff. It's about how far they can take it once they start getting going. How far can they take it?
Well, I think they have a ways to go. I mean, one thing to put in perspective right now, because inflation is running so hot and the rates are at 0 or the 10 years at 1.5%, we have deeply negative real rates right now. So I do think they have to make up that lost ground, and maybe that means faster hiking rates, unless inflation, if Mike is right, really starts to come down next year. So they have to move. That's one thing.
We're going to continue this conversation. Lucky to have Anastasia Amoroso and Mike Collins with us. We'll continue the conversation and throw in a little bit on crude. Coming up, investors applauding OPEC's supply boost escape clause.
The net of this means less spare capacity in OPEC and likely less shale or less Iranian oil. So it reinforces that medium to
$30, yeah, there we go. Drop. Gold pushing. Gonna break this zone. In on the buy. That's only because of the news. Well, I'm not in. 1 minute to go. Let's see where we get. Final trades of the week for us. And what's been a very volatile and you know, one of the first weeks I've lowered my lot sizes. Purely just because of the COVID thing, you know. But we still ended up in profit, which is what it's all about. Focus on this. Here we go. Countdown. 1 minute to go. Get ready. I'm going to say it to be so we can get some sells.
Start exploring to see what's moving the markets. Visit Bloomberg.com webinars.
See what this news is going to be. More sells, more buys. We got 20 seconds.
The antibody responses produced by this vaccination is able to potently neutralize the virus and a number of variants of concern.
Better than expected. Pretty good. Pretty good. 2 positions on there.
A lot of the vaccines being developed currently require super cold storage. One of the great
We're done.
advantages about patch is
Here we go.
that
In and out.
you're able to
Great. And that was I did 5 lots on there, 0.5 for most people, and that was 65 and 46. That was about $130 there in
much simpler proposition.
What was that?
rather than the cold chain.
19 seconds. I'm getting quicker. Getting quicker. I'm getting quicker than ever before. So, okay. 40 seconds. What was the result? And it just bumped up. It just pushed up just a little bit there. From there, look to here, measure it. There's the spike. Again, you wouldn't notice it. You'd say most people go, "What are you selling? It's red." Oh, they don't understand the fundamentals in trading these news spikes and how you can win money from them.
The fact that they went ahead with the increase, we do think there were some political considerations at play over here as well. But the genius move was keeping this meeting open. It's probably going to be the longest meeting ever. Immediately.
So there it is. All you got to do is measure, and it'll drop back down again. But it doesn't matter because we got in on the bottom of that candle. Look, and then the top of the candle. Look at that, 395. We only need 100 to get $100 plus. So.
Change of heart. The White House Press Secretary Jen Psaki applauding the boost in output.
We appreciate the close coordination over the recent weeks
Perfect.
with our partners Saudi Arabia, the UAE, and other OPEC Plus producers to help address price pressures together with our recent
Before we returning to our pan.
from the SPR. We believe this should help facilitate the global economic recovery.
Crude this morning 68.92, up 3.6%. Still with us, Anastasia Amoroso and Mike Collins. Anastasia, this oil picture, how much of it is it a factor in your outlook for the next 12 months for your broad-based allocation decisions?
Well, it's a very important factor. Obviously, if we look at inflation and gasoline prices and oil, that's been a big driver.
Now we're looking for factory orders and ISM non-manufacturing PMI in 12 minutes time. Final trades. Now that's what did gold do? I didn't check gold. Gold sold. There you go. Look, see, so you could have traded gold on that. There you go. Look.
Trades for 2021 has actually been the energy trade. Until recently, it was up about 51%, and then we've seen this complete washout in the oil market.
So you could have sold gold, which is the normal way when the news is good. Gold drops, as you can see. There was top of that candle. You can see, just zoom in. Little moves is what pays the money, pays the bills. So there was the top of the candle. There's where the news came out. The drop, look, and total down the spike. That 245. You really need 100 again. So that was perfect. Perfect drop because the news was good. Mark that so we can have that on the chart for backtest.
Mike Collins, your response, please.
Yeah, well, obviously, John, predicting the price of oil is a fool's errand. I will tell you two things. Right? Nobody thought it would be negative 40 a year and a half ago. I will tell you two things. Right? Oil is very correlated, as Anastasia indicated, to near-term inflation, expectations, and we've been explicitly betting in our portfolios that those inflation expectations peaked and would come down. And sure enough, if you look at the 5-year break even, it was 3.25.
So like I say, gold always, performs as it should once it's in the session.
We are still long energy companies in general.
Remember that most of the time. Again, there's always where you got to use a stop loss. I know I don't set mine, but my stop. If then to sell here and then shut up past our zone here, I would have ended the trade. Want to cry because then I would have just got the pullback on the next trade in. So that you see looks lined up perfectly. News, there you go. Look.
John, as I said, the supply-demand imbalance is already
just, but enough to move it.
At some point, we will equilibrate, and it'll probably move in the opposite direction. I'm worried that in 2 years from now, Jonathan, we're sitting here, demand is down, and now we have all this supply of chips and oil and cars and washing machines coming online, and there's excess inventory, right? That is actually a real risk over the longer term. The markets always overshoot.
Now we've got 9 minutes
So yeah, we're
till
definitely
the final
seeing
trade.
that those break-even rates keep coming down.
Our second leg M forming. Look at that.
You know, inflation swaps.
Perfect. Could have got in, got that cheeky buy, and then gone straight in for the sell. Look, as the RSI broke the zone, and you'd be up.
In the next 6 to 12 months.
155 points at the moment.
I do agree with Mike.
Easy money sometimes, and when you put it all together, and you've got it laid out, you've got a system, you've got a structure to work to. And that's what I'm trying to teach.
Look at inflation, it's still expected to be something like
Consistency. And don't stray from the strategy, from your plan, from your setup. Take the losses when they happen, but be confident that overall you're going to be profitable. Now we're looking for a re-entry. Look at this, RSI 27, 26. Look at that. Waiting for a re-entry on the sell. Bonus trade, possibly.
Equity returns will be more subdued. Bond returns, at least in duration, is likely to be negative next year. And you have this high inflation hurdle rate. So what do you need to do in the portfolio? And I think the answer to that is get things like real estate in the portfolio that actually does have inflation pass-throughs. And by the way, shelter inflation, as Fed Chair Powell said, is heating up. And that's one thing. And the second thing is you need to get hyper growth in the portfolio. And we're finding that today in crypto, and we're finding that today in venture capital.
Can't bring up crypto at the end of the show, Anastasia. We need the extra time to actually talk about it.
Next time.
We're going to do it next time. Anastasia Amoroso, thank you. To Mike Collins, thank you, sir. To both of you for joining us on this Payrolls Friday. There was a really interesting line from Savita Subramaniam at Bank of America a little bit earlier today, and this was in the research, and I'll bring you the quote just quickly. Taper, Titan, Tina, question mark. She says, what happens to the Tina, there is no alternative to stocks trade argument, if cash yields rival the S&P 500's 1.3% dividend yield, and if the 10-year hits 2%, their forecast. Dividend growth needs to keep up. That's our theme, inflation-protected yield. How much inflation protection do you need next year? And that's at the heart of these debates, these conversations we're having. Mike Collins is leaning the other way. That's a story for another time. From New York, let's get you some price action. Rip off the lid of this equity market, get you the sector breakdown. Here's Kriti Gupta.
Well, good morning, John. Started off with a fairly broad rally, but essentially it is a tug of war of tech that is changing the game. At the top of the leaderboard, you have consumer staples and materials, but at the bottom, consumer discretionary and information technology. And like you said, it's that tug of war. You got your Amazons, your Apples, your Googles, your Microsofts. In the leader side, on gaining, on the other side, you have NVIDIA and Tesla weighing the market down. And John, it's no longer one clear trade for tech as it was for so long during the pandemic, which brings me to a check-in on those stay-at-home stocks. Those have lost a lot of their momentum in the last 2 years since that major boom that you saw in 2020. And that's best exemplified this morning by DocuSign dropping almost 40% in regular trading, about 38% in pre-market trading after its third quarter billings and revenue forecast missed those estimates, John.
Kriti, thank you. That's the sector breakdown in the equity market. Here's your bond yield breakdown. 2-year yields higher by 2 basis points, just short of the year's high of about 65 basis points. We had a look at that last week. On 10s, your 10-year totally unchanged now at 144. Coming up, the market moving events, your trading time.
Gold pushing up nicely now. As this is drop, look at that. There is your re-entry point, so you could do an additional trade on that. And gold now pushing up. Market manipulate PMI, and then here we go. Is this going to break and continuing up? So with this last bit of jobs news, we could do with this be the opposite. Could do with this being worse than expected, so we get a nice push up on gold. 5 minutes, 65, it's lower than expected. Anything above 50 is bullish though, they say. Factory orders as well, percentage wise. Always check what that means. Higher than expected is positive. It would be 0.5, so that would be a sell on gold potentially.
The other has an ego in the orbit of Mars.
Look at that on US 30. Perfect. Perfect sales. you know, you were holding sales from NFP. Now look at that profit you'd be in. Look at that. So you sold here. You didn't catch the spike. You didn't get out in time on this NFP spike. Then yeah, if you got the drawdown your account, and you'd know that would be your stop loss level. Look how it spiked out of it. So you just have to be above it. Look at that. You'd been well in profit if you hold. The good thing is you don't need to if you follow what I'm doing. RSI it's still struggling. Look, still struggling to break that like 59 level. As you can see here, look, it's hit it 1, 2, 3, 4 times.
When you start late, at some point,
there's no buys yet. We're going to wait for this news. 3 minutes to go. Final trades of the day. We've been going 2 hours and live streaming, and we've done about 25, 26, 7 trades or something like that. I'll add up at the end of the day, including we didn't trade anything in Asian session because it was looking too volatile, so I avoided it. But we did trade the London Open. So
to next week, a CPI print next Friday, then on to that final Fed decision of the year. The price action looks like this on the S&P, down about 1/3 of 1%, doing okay. The Russell underperforming.
all this, and they're all saying, oh, so good, everything's so good, so positive, look. I love it. You know, they're like, hey, yeah, it's good, oh, it's not as bad as expected, look at the underlying. Oh yeah, here we go. Oh, no. I love it, I love it.
Later in the week, initial jobless claims on Thursday and
Yes, there we go. Next week, CPI.
This week with Bloomberg Real Yield, an all-star lineup, 1 p.m. Eastern Time. Francis Donald, Bob Michael, Krishna Mamani. Do not miss that. If I missed you, have a wonderful weekend. Thank you for choosing.
Here's Jonathan. Thank you for your manipulation. Thank you.
Here's Bloomberg.
Love it. Right, here we go. 2 minutes to go.
How does an extra $1 trillion in spending not increase inflation?
By increasing the productive capacity of this country. And that's a very important thing that we frankly have not successfully done across most of my lifetime. You know, I've been waiting for this legislation for months since I became Transportation Secretary, but various presidents have been hoping to reach this day for decades, and it hasn't happened for all kinds of reasons. The American public has been rightly impatient. Now we're getting it done, both making up for lost time and
Here we go.
a better foundation for the future. Let me also point out the fact that Part 2 of the President's agenda, what I like to call the big deal, but Part 2 of that, the Build Back Better Act, has even more that will help beat back inflation by lowering some of the costs that Americans feel most acutely, the cost of childcare, the cost of
Gold, here we go.
housing,
Here we
cost of
go.
prescription drugs, bringing those down.
Remember on gold, go the reverse. If you're going to trade gold, US 30 with, it could be just a little spike because look at the downward pressure we've got building up on here.
Lots happening on Wall Street. It's the basic law of economics.
The Fed is telling us inventory.
Need to catch up. This is Bloomberg Wall
Let's see if we can get a clean sweep.
We've got the information and insights. David, you just hit the nail right on the head.
8 seconds. Good luck, everybody, if you're going to do this. Final trades of the day. Factory orders and ISM non-manufacturing PMI. Looks like it's all good as I expected as well. So it could be some nice buys. Yeah, we just got $100 on that, and We get a sell on gold. Yeah, we did. There we go. Done. Done. Managed to get 41 on gold, 28 on gold, and a buy of 48 on US 30. All done in 17 seconds was the US 30 trade. Beautiful. So 3 trades there. I didn't get a 4th because my broker didn't execute the trade, otherwise I would have done. But there you go. Perfect end to the week. 58 seconds, all done.
For a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between overextended
as you can see,
and a suffering populace falls on the private citizens.
News was better than expected. Easy scalping.
Some might be tempted to label him as disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis,
Well done. Perfect. Let's have a quick look. Again, you won't know that price action on there, but there was the pullback.
We're here in San Juan. They have telecommunications restored. You may or may not have power, but basic services are in place.
Factory.
They're buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that
There's
are
that nice
devastated.
spike up just here. Look, beautiful.
I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents.
And look at that. Oh, look at that spike on gold. You see, it's perfect. Look at that.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical
Good news. Drops gold like a stone. Perfect.
Filled the van with medical supplies at her own expense and brought along a
That's the proof why fundamentals are the best way to trade. Day trade, intraday, day trade. Well, there we go.
Our first stop was the home of an 82-year-old man. His roof was blown off by the storm. He's been living alone in a back shed for nearly 2 months.
This cane actually got broken in the storm, so there's limited mobility. He has a number of medical ailments. Dr. Priester's having a look at him. We called the PA for you to set up what he needs to stabilize him. He can be transported either to an evacuation center or off the island.
Perfect green.
The cane gets broken when those families that are connected to him leave the island or take off at the end of the road, and it's tough.
FEMA was not officially part of the project, and their arrival took everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid in mind.
People think that FEMA is there to hand out lots of water. That's not what they do. FEMA has a role to play. They have a very specific role.
Well, there you go. That is it. We're all done. As you can see, the calendar has come to an end for this week. And that's it. I mean, you know, what more do you want to see? It's kind of like, you know, trading the fundamentals. I'm not saying it's easy. You've got to have a system. You've got to watch price action. You've got to know what's going around you, watching the news, when you get the patterns right. But it's all here, and the Axe trading system gives you that edge. And even though, you know, like we're looking at a second leg M on here, you've got to trade the buy. It's good news. It's going to be worth 100 points, and that's what it was. And then let it drop back down again. So if you're quick enough, and if you want to, and I don't do it, but you could go the buy, then the sell, and you'd have been both ways. Win-win. You know.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, but now with FEMA in tow, he created his own maps to survey storm damage. Delivered them to FEMA HQ free of charge. Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And with these relationships,
true scalping.
allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a family of 11 struggling to care for their special needs brother in what was left of their house.
Really, we are the first.
That's great. A good session, and just let's have a look. I think it was about 30 trades all in all.
The difficulty with this is the patient cannot be alone. The most important thing is that you need to take
For the day.
Besides disability, because they have been not going to a doctor, and no doctor has coming here yet.
Yeah.
After maybe 54 days,
So,
it's not getting better.
in the end, we pushed to about nearly $2,000. There you go in the session. So perfect. Great day. Great day. Again, doesn't matter if it's $10, $50, or $100, or $2,000. It doesn't really matter. What to do is to do with is getting the wins, getting the pips on the table. Then you can always increase your account size, compound it, or add money to your account to trade bigger lot sizes up to the level that I kind of do. But it's all about having the system in the first place that gives you the wins and gives you the pips. The kind of monetary value isn't really relevant. It's getting the confidence and getting the wins to trade the news, trade the opens, and use it in conjunction with TA, the axe system that we've got here. So I hope you enjoyed that live stream. Like I say, we've got over 30 trades today, all wins. We'll close all our positions. That's it. We're done for the day and for the week. We probably averaged about 20 to 30 trades per day. But that's micro scalping, true scalping. That's the way you do it. We're in and out, consistent with our lot sizes. I upped them today because of it being NFP. If it's volatile out there, I'll go back to 0.5 on my gold and 3 standards on US 30 as opposed to 5 and 1. And that's about all I adjust really. You just got to keep consistent, keep banging away, do it on demo until you get the confidence, then put some money in and go. Accept the losses when they come, but reset and start again. So yeah, anyone wants information on how to join the group, get me as a mentor, go to the website www.mohawkforex.com. I'll look in the description below and look forward to more people joining the Discord group over the next year as we continue to push forward with true scalping. We've got more things and systems coming out in the future as well. But until next week, have a good weekend everybody, and hope you enjoyed that true scalping session. Trade safe as always, and yeah, have a good weekend, and I'll see you on the other side. Take care everybody, see you later. Thanks for joining me as always, and give us a like. Cheers.